What's up, guys? How you doing? So this video is strictly for those who want to learn how to make money from the forex market. It's going to be a very long video, so if you do not like long videos or you are not interested in making money from the forex market, feel free to scroll. Okay, but however, if you want to learn how to make money from the forex market, this video is for you. Now, this is that video I wish I saw when I was starting out in the forex market. This year I'll be 8 years experience in the forex market. I've been privileged to make a lot of money, and this is me giving back to you. This is me teaching you how I've been able to make it in the forex market, the things I knew, the things I learned, and how to actually get started, especially if you know nothing about the forex market. Now, this is that video that you need to watch first before you watch any other video about forex. Now, this video will give you a footing and to get you started, okay, so that you do not get confused on your journey to learning forex. Okay, so forex has been it's a skill that can help you to make a lot of money and quite fast, and is also a skill that can help you to hedge yourself against the depreciation of currency, whatever country you are. Especially if you are in an African country, you would learn how to be making money in foreign currencies while in your home country. So this is that video that you must not skip if you are intending to make money from the forex market. So it's a straight to the point video. I will not try to play around. I will not try to take a lot of time. Straight to the point. We're going straight into forex, starting from what is forex. So even if you know nothing about the forex market, in fact, the lesser you know about the forex market, the more you stand to gain from this video. And trust me, this is a training I recorded about a year or 2 years ago. However, after 3 months, I put the video on private. I unlisted the video, and it has not been live on this channel for quite a while. But trust me, this is that video that would help you to know everything you need to know to get started in the forex market. So I'm relaunching that video on this channel today because a lot of people keep asking me basic questions about, okay, what is this, what is lot size, what is leverage, what is risk management, blah blah blah. Now this video will answer all your questions. It's going to be a 2-hour video, and at the end of those 2 hours, trust me, there's a lot you're going to be learning. So make sure you're not skipping any part of this video. Stay patient. Watch the video patiently. Just give me your undivided attention for the next 2 hours. Try not to do anything else. Try not to be distracted. This is the best 2 hours of your life right now. Let's dive right into the training now. If this is your first time coming across my channel, I have over 200 videos on this channel to help you to become successful as a forex trader. So I'd love you to smash the subscribe button and do well to also tap the notification icon so that you'll be notified every time I go live here to practice the things I'll be teaching you in this video. So give this video a thumbs up. Let's dive right into the teaching. Let me teach you how to make money from forex. Welcome to the TradeWeave bootcamp handbook. Okay, so I'll just do an overview of what we'll be discussing in this particular class, and then we'll get started. Okay, so this is what the handbook actually looks like. So as you can see here, it says that this handbook is a compressed version of the full trader video training course. This is the module 1 to 5. Okay, now the TradeWeave training course is actually a 10 module course comprising of over 20 video materials, that teaches like A to Z of the forex market. Okay, so and this is a link to actually get the course if you want to, but it will actually be somewhere around this video. Okay, so but don't bother about this for now if you are not interested in getting the course. If you just want to learn the forex market and start trading immediately. Okay, so this course will be a fully detailed course on the forex market. Okay, so it will be actually divided into 10 modules, which you would actually go through like really shortly. Trust me when I say forex is not hard. The learning aspect of forex might be what seems hard to a lot of people, but trust me, there is nothing hard about trading the forex market. It is something that you can learn. It is something that you can do. It is not rocket science. Okay, I've been trading the market for over 6 years, and trust me, it's like the simplest thing in the world to me right now. Okay, the hardest part is actually the learning part. So that's why for these few hours, maybe few minutes, I don't know how long this video will be, I want you to give me like your undivided attention. This is the 1 hour that can change your life forever, just the same way a single attendance of a forex event changed my entire life. this can actually be that life-changing for you. Okay, so please give me your undivided attention. I promise to teach you every single thing I can about the forex market. So module 1, we're going to we'll be talking about introduction to the forex, to the financial market. What is forex? History of the forex market. Overview of trading and versus investment. Also be discussing module 2, market trading sessions, the best trading sessions, currency pairs and assets. What do they mean? Types of currency pairs and all of that. The keywords and terminologies that you should take note of if you want to trade the forex market. We'll be discussing that in module 2. In module 3, we talk about the types of traders, the types of market analysis, the types of trade execution, brokers, and the market makers. Okay, so module 4, we'll talk about what is a pip, what is a spread, what is a lot size. Then I'll be introducing it to chart representation. I know you must have seen a lot of these zigzag lines all over the place when you see forex traders doing that thing, and you're wondering like, what the hell are they doing? I'll be teaching you all of that. Okay, so market highs and lows, we'll talk about that. The line, bar, and candlestick chart, we'll discuss about that. Now we'll do a full approach to candlesticks and charts, introduction to chart patterns, candlestick sentiments and analysis, types of chart patterns, time frame analysis and relevance. Then we'll do introduction to support and resistance. Please don't be scared. I know at this point it's looking like we're going to be learning a whole lot, but trust me, this is nothing. Okay, and I'll try to compress all of this. It might be really big, it's actually like a very difficult thing to do, but I'll try my best just to give you enough for you to get started, for you to start trading, at least enough for you to start using our free signals to trade and make money from the comfort of your home. It is our goal at the Trade With Academy to help at least 1 million traders out there to become successful traders before the end of 2030. Okay, so that said, module 6, introduction to trading terminals, how to navigate the MetaTrader 4 app. We'll talk about types of market orders, how to place a position, broker spread, commissions, risk to reward ratio, and all of that. So module 7, we'll talk about how to determine the best lot size for your capital. We'll do a full approach to trading psychology, strategy development. Then we'll introduce it to indicators. Now, like I said, all these modules are like 1 hour 30 minutes each, dedicated to teach these things in the full bootcamp course. Okay, like in the full bootcamp course, all these things, all these modules I'm mentioning, this is like over 20 different videos explaining each single one in detail. Okay, but I'm trying to compress all of this into one single video. Okay, so let's keep going. Now module 8 is where we talk about the trader's age, the trade psychology, how to start trading, capital recommendation, and how understanding the demands of a professional trader. Okay, module 9 is where we talk about the strategy that we use to trade. We have trade strategies that we teach at the Trade With Academy. Each one is much more adapted to a particular kind of trend in the market, particular kind of market setup. Okay, so I might not actually give you the strategy that we use actually to trade, because that would really be unfair to the guys that are purchasing the full course. But however, I'll teach you something that works and how to get started. Okay, now module 10 is where we talk about just do a full recap of everything I've taught you, how to get capital, then teach you about the multiple streams of opportunities in the forex market, how to get your investors, how to scale your trading profits, and then I'll give you my final advice and I'll congratulate you for completing this course. Okay, so trust me, if you're distracted at this point, you will not get anything out of this, because I just invest this 1 hour. Trust me, and just give me 1 hour of your time and watch. Things really change for you by the time you're done with this course. Okay, so give me that 1 hour undivided attention and let me teach you these things. Let me teach you how to get started trading and how we make money and how to trade off our signals and make money, free money for yourself. Okay, we ain't charging you nothing for the free signal channel, absolutely free. Okay, so you really have nothing to lose watching to the end of this video, really. Okay, so let's move into module 1 immediately. Okay, now a lot of people, let's start from module 1. We're in this lecture now. So the financial market, most people believe that the financial market is equal to the forex market. They just believe, once they hear forex market, they just believe it's the same thing as the financial market, but it is not. The financial market is any market where financial securities and derivatives are traded is the umbrella name for markets like the stock market, the bond market, the cryptocurrency market, the forex market, and the commodities market, and some other sub markets that are under the financial market. So forex is just one single market under the just under the umbrella name financial market. So just forex is just one name under all of this. Okay, now, like I said, I will explain some of these things in details because it will probably be unfair to the guys who are purchasing like the full course. Okay, but however, what I'll give you is just enough to get you started. But if you want much more in-depth knowledge about these things, grab the course, grab the Forex Bootcamp course. These things are explained in much more details. But for the sake of this video, I don't want this video to really be that long. I just want to give you enough for you to start trading immediately after you watch this video. Okay, so let's get going. So that's it about forex market. Now, what is forex? Now, forex simply means it's just a combination of two words. Let me take a water break immediately. Okay, that was refreshing. So forex simply means foreign exchange. Okay, now it's a $7 trillion market. What $7 trillion market simply means is that every single day $7 trillion exchange hands between people from all over the world. Every single day, $7 trillion. Just imagine that $7 trillion is just moving on the air. Somebody somewhere is taking $1 million. Somebody somewhere is donating $20,000. Somebody somewhere is collecting $3,000. Somebody somewhere is donating $25,000. Somebody is collecting $55 million, and that person is giving out $53 million. Just see like a pool of $7 trillion every day. People are taking, some people are losing, some people are winning. But at the end of the day, by the time you check the whole transaction, over $7 trillion has exchanged hands. It is the biggest market in biggest financial market in the whole world. Okay, it is the largest financial market. Okay, so followed by the stock market and all of that. So let's just keep moving. So history of the forex market. Now, forex market goes as far back as 2,500 years ago. You know, when the Greeks and Egyptians used to, you know, exchange gold and silver and all of that. So what that actually means, because like I already mentioned, forex means foreign exchange. What that simply means is that what foreign exchange simply means is when you exchange a currency for another currency that is not your currency. Okay, foreign means something that doesn't belong to you, right? So foreign exchange means when you exchange your currency for another currency that is not your currency. It's that simple. Foreign exchange. So when the Greeks were exchanging gold and silver, gold for silver, silver for gold, it was actually foreign exchange. Okay, so then of course you can read this up in the manual, in the handbook. You know, the slightest the earliest form of modern trading was like 500 years ago and all of that. Okay, then as of 2013, USD became the most traded currency in the whole world. Okay, now there are big players in this market. There are people that like are the big guys that play in this market. We have the big banks, the hedge funds, the big commercial banks and all of that. Now these are people that have like the big money, guys that trade in billions of dollars in this market. Okay, so those are the guys whose money are actually like moving the market, making the market move this way, move that way. They are like the big guys. Okay, so what we retail traders do, what we, you know, small guys, you know, in the market that hope to trade, maybe you have maybe $500, $20,000, $1 million, $20 million, $100 million. Those are really still small money in this market. Okay, we're talking about $7 trillion here, man. So the guys that really have the money that move the market are the big players. Okay, the commercial banks, the hedge funds, and I'll tell you how that works and how their money actually moves the market like shortly. Okay, so let's keep going. So let's do an overview of trading. Now, trading simply means exchange. Okay, you're exchanging money. It's that simple. There's nothing complicated about this, right? Exchange, you exchange something for something. Okay, so it's that simple. Now let me give you an illustration of how money is actually made in the forex market, like the simplest term to explain this. Now, for instance, let's say I traveled to the US. Let's say I traveled to somewhere, maybe New York, in 2013, and I was given $100 bill by my uncle, just to do, buy Christmas stuff, right? So I came back with that money, but somehow I forgot the money. Forgot the $100 bill inside my pocket. Then this is like 9 years later. This is 2022, and for any reason, I just brought out that trouser that I kept the money, and I just saw the $100. Wow, $100, 9 years. So, and I decided to exchange that money currently. About 9 years, let's say 10 years ago, dollar was about, let's say, maybe somewhere around 200 naira, but now currently is about, let's say, $750, 750 naira per dollar. Right now, I've simply made over that's 75,000 minus 20,000, that's over 55,000. Right, I've made 55,000 naira over 10 years just by simply keeping my $100 bill and not spending it. So at the time I'm exchanging it, the price is actually higher than it was when I was giving that $100 bill. So in how money is made in trading is simply trading in layman's terms. Okay, simply means exchanging a currency with another currency at a specific period, at a specific price, and at a specific time. Okay, so whether you made a profit, whether you made a loss, is still called a trade. Okay, you understand that? So that's actually trading. That's like an overview of trading. These things are more detailed in the course, but I'll leave it at that at this point. So let's keep moving. Now let's talk about trading versus investment, because a lot of people confuse trading and investment. They believe trading is investment is trading, but that's not true. When you're a trader is simply looking to like make money in and out of the market. The person just wants to buy, let's say buy the euro. When it increases in price, it immediately, once there's an increase in price, once the profit is made, just takes the profit and moves out of the market and all. But as an investor is more like a long-term player. He wants to like see how far the profits can go. Just in summary, traders are just short-term, investors are more like long-term players in the market. Okay, so let's just keep going. Let's move to module 2. Wow. Now, module 2 is where we talk about the sessions, the currency, and the terminologies you need to know in the Forex market. Now, the Forex market has 4 sessions, okay? 4 major sessions. What this means are I would use the word, it's not headquarters, however, but I'll use the word headquarters. The headquarters of the Forex market is divided into 4 markets, or they have different headquarters, for trading, okay? Like I said, the word headquarters is not actually in context, is not correct, but I'll use it to aid your understanding. Okay, just assume like I don't know where you stay, but I stay in Abuja, so there are like big markets here in Abuja. Okay, they have like the Wuse market, it's a really big market. We have the Gudu market, it's actually really good market too. We have the Utako market and all of that. Okay, so however, that's the same way you have like different markets, different trading sessions in the Forex market. This simply means, okay, let me just explain the 4 of them. Now we have the United States trading session. Okay, we have the London trading session, we have the Tokyo trading session, and we have the Sydney trading session. It's really simple. Now the first market to open every single day is the Tokyo session. Okay, Tokyo session, I think I'll just need to put off these notifications. So sorry about that. Let me put this off. This will really take my time, so let's just keep going. So the first session market to open is actually the Tokyo session. Let me explain that here. The Sydney session, sorry. So the Sydney trading session opens by 22 GMT. That's like 10 p.m 11 p.m Nigerian time. Okay, it opens and starts trading, okay, till 6 p.m GMT, 6 a.m GMT. Okay, now the Tokyo session opens 2 hours after the Sydney session opens. That is about 12 a.m, that's midnight, and then closes about 8 a.m 9 a.m Nigerian time in the morning. Right now the London session opens by 7 a.m 8 a.m in the morning. 7 a.m 7 a.m sometimes they open 7, sometimes they open 8 a.m depending on their seasons over there. Right now, and then closes by about 4 p.m 4 p.m. In the afternoon, that's Nigerian time, which is 16:00 GMT, right? Now, United States session opens by between 2 p.m. and then closes about 9 p.m., 10 p.m., Nigerian time here, right? So that's like the 4 market sessions. So now the thing is this, because most times when I explain this, trying to teach this at the Trade With Academy, people get confused. They're like, is it that there are some things you can buy in this market that you cannot buy in this market? No, that's not true. Now, this is a very simple example. Now, if you look at all the markets that in your place, there are commodities that are much more easy to get in particular kind of places, in particular kind of markets. Okay, for instance, if you go to there's a particular market that is called, I think there's a market called fish market, right? Somewhere around Apo or something. So that particular market is easy to get foodstuffs. Okay, easy to get groceries, anything that's related to cooking food, it's easier to get it there. Now, a market like, let's say, Wuse market, which are like the big markets, you can't just go there just because you want to buy foodstuff. Of course, you can get some foodstuffs there, but however, people go there to buy like maybe clothing, shoes, bags, gold, those kind of things. Okay, so for every single market, in this trading sessions, there are some currencies that are much more volatile. For the Sydney and Tokyo trading sessions, the AUD, which is the Australian dollar, I'll explain all these currency pairs very soon. Okay, the Australian dollar, the New Zealand dollar, and the Japanese yen. These are currencies that are much more volatile during this period. Now, during this period, you can also trade every other currency out there. The forex market is a 24-hour market. It never closes. Okay, just that some sessions, some currency pairs are actually much more volatile, because in Sydney and Tokyo, the Australian dollar, the New Zealand dollar, the Japanese yen are currencies that are much more used in this particular this terrain, right? And also this is like during these times of trading, specific to these trading sessions are like their daytime. Okay, like they are 8 a.m. to the regular 5 p.m. working hour, the regular 9 to 5, right? So all the news events that affect their currencies and everything comes out within these hours, okay, which coincides with our midnight time, right? So during this time, their currencies tend to be much more volatile during these seasons, right? During these sessions, right? During this time. Okay, so that's it for Sydney and Tokyo. So the London trading session coincides with our regular 8 a.m. to 5 p.m. work time. Okay, so during this period, currencies like the Great British Pound, the Euro, these are currencies that are much more volatile during this period. Okay, of course, the Canadian dollar too. Then we have the United States trading session, which opens by 1 p.m., 2 p.m. during the daytime, which is like our Nigerian time here. So during this time, of course, the US dollar, very much volatile, and the Canadian dollar, the great, what's it called, the Swiss franc, the JPY2 is also really volatile during this period, right? So, but however, what I'm trying to say is this in summary, trying to summarize everything I've said about trading sessions. Every trading session, you can buy and sell all the currencies you want to buy and sell. But however, there are some currency pairs that are much more volatile, specific to each trading session, depending on the currencies that is most used, or currencies that are native to this particular regions. Okay, it's that simple. So let's just keep going, right? I think I just need to close this. Let's just keep going, right? So let's talk about the best trading session. Now, ideally, there's actually nothing called the best trading session. But however, when we say best trading session, we actually mean like the best time, to catch volatility in the market. Volatility means like when the market is much more, when there's rapid movement, there's a lot of movement that can, you can maximize, you can trade off. Okay, so the best trading session for us here in this region, Nigeria, is between the London session and between the close of the London session and the opening of the US session. Okay, now the London session closes typically around 4 p.m. 4 p.m. evening. That's Nigerian time, okay? And the US session opens around 2 p.m. So between 2 p.m. and 4 p.m., both the US trading session and the London session are both open. Okay, both sessions are actually open. So what does that tell you? That tells you that there's a lot of movement happening within this period. Okay, because a market as big as London session, which is like I think the biggest, and the US session are open at the same time. Like this is like opportunity. A lot of movements are happening. This is like the period where the market is much more active. You see a lot of up movement, down movement, and all of that. So it's really a good time to maximize your trading. So that's why we refer to it as the best trading session. Okay, so yeah, you can actually call it the market it's called market overlap. Okay, and so some people refer to it as market rush hour. Okay, so let's just keep moving. Now there are currencies in the market. Now, like I already mentioned to you right from the time I started talking about the Egyptians and the Greeks exchanging gold and silver, I told you that currency pairs must be traded against another currency pair. You can't exchange naira for naira to make money. Naira must be exchanged with dollar for any form of profit to be made, right? And let's say dollar must be exchanged with the Great British Pound for money to be made. Okay, so in trading is done with in pairs. Okay, a currency must be in a pair for it to be traded. Of course, you know what a pair is, double, right? So that's simple. So for instance, if I want to buy if I have a euro, okay, 1 euro, I want to exchange it against the dollar, against the US dollar, and I want to trade it, I want to call it a trade. That pair, that euro and USD must be is indicated and shown, displayed as a pair, as a single pair. So for instance, this is euro, this is USD. Both currencies are called the euro USD. Okay, and I'll tell you how that works, like very shortly. Okay, now for euro, for every currency pair, every currency pair has two parts to it. Okay, there's the base currency and there's the quote currency. Now the base currency is the main currency that you are actually working with. Okay, for instance, we're in Nigeria, and all the reference we make to dollar is in relation to the value of the naira. Nobody cares. For instance, $1 remains $1, has been $1 in the US for many years. Okay, but in Nigeria, $1 keeps meaning different things. $1 can mean today 700 naira. $1 can mean next tomorrow 750 naira. $1 can mean tomorrow 500 naira. $1 can mean 1000 naira by January, right? So all the reference that we are making is to to the dollar. Okay, so in a base currency, I'm just trying to help you understand it so you're not confused. I don't want this to confuse you, right? So the base currency, for the sake of this tutorial, you can just refer to that as your currency of reference. Okay, so if you're saying you want to buy the euro, what you actually mean is, when you want to buy the euro, what you actually mean is that you're trying to exchange the euro for something else. So it can be, this quote currency can be USD, it can be Canadian dollar, it can be GBP, it can be CHF, it can be any other currency, but your currency of reference is actually the euro. Okay, so just have that at the back of your mind. Just think of it that way. Okay, so ideally, when a currency is bought or sold, the main currency being traded is the base currency. Like I already told you, the base currency, which is your currency of reference, is actually called the base currency. Okay, now the quote currency is considered the price relative to the main base currency being traded. Okay, understand that? Let's keep going. Now, in summary, currencies are never traded in isolation. They are always traded in pairs. Now, let's talk about the types of currency pairs. I already mentioned there are lots of currency pairs out there. There are over 28, if not 30 currency pairs out there that you can trade. But however, there are 8 major currencies. Now, I might be using the words interchangeably, currency pairs and currencies. They are not, when I mean currency, I mean just one single currency. When I mean currency pair, I mean when you're talking about the pair, like the combination of maybe the US dollar against, with the CAD, or the CHF with the JPY, something like that, right? So these are the main major 8 currencies traded in the Forex market. Okay, and their nickname, right? Now let's talk about the euro. Now the euro, of course, definitely we all know the euro, right? The United States dollar, of course, we know that. The nickname is BOC, British pound, sterling. Of course, if you heard pound sterling, right? Sterling is actually a nickname. Australian dollar, Aussie. New Zealand dollar is called the Kiwi. Canadian dollar is called the Luni. Japanese yen is called the JPY. The Switzerland franc is called the Swissy, right? So now let's talk about the types of currency pairs out there. Now, there are three major types of currency pairs. There are major pairs, there are minor pairs, and there are exotic pairs. Okay, now the major pairs are simply this. Every currency pair out there that you see that has the USD as their base or quote currency are called the major pairs. Okay, because it has the the US dollar. So every single pair that you see a USD attached is a major pair, like the USD card, Euro USD, USD CHF, GBP USD. These are all major pairs. Okay, now the minor pairs are pairs that does not include the USD, but at least it has one out of the three most traded currencies. Okay, like the JPY, the GBP, or the euro. Okay, so currencies like the euro card, the AUD NZD, GBP card, these are all minor pairs. Okay, now the exotic pairs, these are pairs that crosses any of the major pairs with currencies from developing countries. Okay, like the USD South African rand, USD Singapore dollar, USD Hong Kong dollar. This is USD SGD, this Singapore dollar. HKD means Hong Kong dollar, right? So these are currencies when you combine like the USD with currencies from developing countries. Even the Nigerian naira is actually developing countries. So USD NGN, which is USD naira, US dollar to naira, is actually an exotic pair, right? So let's keep going. Now these are terminologies that you should take note of, right? Now, when you want to buy, because of course you've heard buy and sell, we are buyers, we are sellers. There's nothing complicated in those jargons, right? Buy simply means that you're buying a particular asset hoping that the price goes up. Okay, because for instance, if I buy a bottle of water for 100 naira, if I sell it for 100 naira, I didn't make any profit. The price has to go up to like maybe 150, 200. Then when I sell it, that is when I actually make money, right? So that's typically what buying and selling actually means. Okay, so for selling simply means that you are actually selling a particular currency. You're hoping that the price of the currency actually goes down. Okay, it's really simple. When you say you want to sell a particular currency pair, you're hoping that that currency pair, the price of it actually goes down. When it goes down and you buy back, you buy more quantity of that particular currency pair. Okay, now I explained this in detail so it's not confusing. Shortly I'll explain that in detail. Okay, because most times when I explain the buy and sell, people are much more confused when they see the word sell. Okay, but there's nothing complicated. Now, well, let me just explain this now. When you for instance, when you start a trading capital of, let's say, 1,000, that's you start trading with $1,000, it is assumed you have all the currency pairs in the world. You understand? The broker gives you access to trade all the currencies. So you have euro, you have CHF, you have GBP, you have all of that. It's all yours. You understand? When I mean you have that, like your capital can be converted to any of that, it's yours. So when you're selling, let's say you want to sell the euro USD, it is assumed that you already have the euro. So you're hoping the price of the euro USD as a pair goes down. So when it goes down, you can buy it back. Buying means like closing the trade, okay? Because if you're entering a trade as, if you're entering a buy, if you buy a particular asset and the price goes up, for you to exit that trade, you're selling to somebody. You have to sell. Somebody has to buy it back from you for you to make money, right? The same thing with sell. So when you sell, you're hoping that the price of the currency pair drops, then you now buy it back, which now means that somebody else somewhere has actually sold to you at a price which makes profit for you, right? So I'm hoping that this is not confusing, but however, as we go much more forward, you would get this. Okay, so long is an alternative term for buy. Okay, you've seen people say I'm going long, means they just want to buy. Okay, they want to buy. Short means they want to sell. Okay, now bulls and bears. Now bulls are, still buyers in the market. Bulls hoping that price goes up. Now the reason why it's called bull is because when you see a bull attacking, the bull tries to hit the victim, just push you into the air. But however, when bears are attacking, you're trying to push you down, trying to hold you to the ground and devour you on the ground. So bull simply means buyers, bear simply means sellers. Okay, so bulls means if they say the market is bullish, simply means that the market is going up. If they say market is bearish, market is going down. It's that simple, right? So trend is simply means the overall direction of the market. What is the overall? Is it up? Is it down? That's the trend. Okay, an uptrend is when the market is going up. Downtrend when the market is going down. That's simple, nothing complicated, right? Now a ranging market, which is ranging or consolidation, means the market is sideways. It's not going up, it's not going down, it just keeps moving like in the same range. Okay, now a broker is simply a company, or actually it might be an individual, between you and the forex market. There are people, because on a regular day, you with your, let's say, $1,000, $2,000, $5,000, $10,000 cannot actually interface with the market because that money is actually too small. So the broker comes to offer you something called leverage to make your money much more bigger than it looks, so for you to be able to participate in the global forex market. Okay, they do this in different ways, which I might not be explaining in this particular video. There are ebook brokers, there are ebook brokers, but however, those things are much more explained better in the full course. Okay, now leverage is a term. I already explained it briefly when I was trying to explain broker, but however, leverage simply means is a ratio of equity offered by the broker for every corresponding capital available for your trading. Let me explain what that means. They offer leverages like 1:200, 1:500, 1:1000, all of that. What that means is, for instance, if you have, for every $1 you bring, they offer you $200. That's if they are giving you 1:200. For every $1, they give you $200 to trade. They present, not like they are giving you actually, but in the market, they are presenting what you have as 200. That's if your capital is $1. So if you have like a $1,000 capital and you're taking a 1:200 leverage, okay, what that simply means is that they are representing your money in the market as $200,000, which is like $1,000 times 200. That's 1:200. Okay, so that way it makes it much more easy. It makes it possible actually for you to interact with the global pool of liquidity in the market. Okay, so that's what brokers are. So you cannot trade without a broker. You need a broker. So I'll be recommending my broker that I use, that they're like the best I've seen out there. Okay, they're like the very best. I don't have any affiliation with them, however, but then they're like the best I've actually seen out there. I'll leave the link so you can actually register with them somewhere on the description of this video. Okay, so we are now at module 3. I do hope that we've been enjoying like this class so far. Oh my god, so talking is a lot of energy, man. So let's move over to traders, analysis, and brokers. Now, there are types of traders out there. There are different types of trading styles out there. There are people that are called the scalpers. These are guys that just want to enter the market quick. They just want poof. They collect their trade, collect profits, and move out of the market. I think I'll need to move this to the middle. Good. So these are guys that just they don't want to waste much time in the market. They're just out there like to make their profits. They just want to collect like very quick profits out of the market. They move. These are the scalpers. Now the day traders are guys that every single day they come to the market, they hope to make profits. Okay, every single day they come to the market, they're hoping that they open a trade, close a trade, and it ends them in profit. That's just basically what a swing trader, a day trader actually does, which is this here. Okay, now the swing traders are longer term traders. Okay, they actually stay longer in the market, and secondly, they hope to capture what is called a swing. Okay, so I hope you can see this cursor here. So from here to here is one swing, from here to here is another swing, from here to here is another swing, from here to here one swing, from here to here one swing. So each of these movements that you see, up one swing, down one swing. So the swing trader hopes to just capture like the very swings like that, but they stay longer time trading the forex market. So when they enter a trading position, for instance, they're hoping that that trade lasts, stays active for, let's say, 1 full week, 1 full month, as the case may be, though. So those are swing traders. So this is like the summary of that. So by the time you're watching this video, I'm hoping that you must have downloaded the handbook, so you can just read up these things for yourself. Okay, so let's talk about types of market analysis, how to analyze the market. Let's talk about how to analyze the market. Now, analyzing the market simply means you're trying to predict what the market can do. Now, I use that word predict very conservatively, because when you say predict, it looks like you're talking about maybe Bet Niger or any form of sporting bet or something like that. But that is not what we're talking about here. Analyzing the market simply means it's a set of approach, signs, strategy, indicators, and confirmation that must be met in order for you to make a trading decision. Unlike any other betting or gambling site or something like that, when you're making an analysis, based on available data, based on historical data, based on news events, based on different market setups and conditions that are predictable, because the forex market is a very predictable market. You can predict what the market will do. You can predict the possibilities that are available in this market. These are all things that you can do. So there are 3 ways to make this kind of analysis, right? Now, first is technical analysis. Now, this refers to the use of data from market structure and history of price behavior to make a trading decision. Let me explain what that means in very simple English. It's very simple. You just go back to the charts, notice and take note of all the patterns, the movements, the ups, the downs. Take note of the fact that by the time you look through historical data, look at the chart, you will see that there are kind of repeating patterns that you just keep seeing out there in the market. So let's say anytime you see the market went this way and went this way, next thing you see that it goes like this. So by the time you take note of all of that, it helps you to make your decisions. So anytime you see a pattern that has been repeated in the past, then you enter the trade, okay, hoping that that pattern plays out that same way you saw it on the previous chart, on the historical data, right? So that's just it. What's the technical analysis? It just refers to the use of data from market structure and a history of price behavior, how the price has behaved in the past, to make a trading decision. That's it for technical analysis. Now, the second type of analysis is the fundamental analysis. It's simple. Fundamental analysis simply means making decisions based on news events, okay? Because, for instance, when they reduce news events in the US, it affects their currency, okay, affects the inflation rates and all of that. So all those things has a way of affecting the price of the currencies that have price of currency pairs that have that particular currency, okay? For instance, in the US, there's a particular data called the non-farm payroll, okay? It's more like what the data they use to discuss their employment rate and all of that. These are just indicative, indicative news, indicative data. So once they release those kind of news, it affects the US dollar, because by the time that data is released, it shows like whether the US dollar is actually progressive, whether it's retrogressive, and informs investors whether it is okay to invest in the US as a whole state, as a country, and things like that. So it actually makes the US dollar really volatile. So that's it for fundamental. So there are traders that just use fundamental analysis. They don't even look at the historical data. They just position themselves. For instance, if they perceive or if they predict that the news that is going to come out will favor the US dollar, they will take currency pair. They will take trades that will favor, the strengthening of the US dollar. Okay, they just position themselves, take those kind of trades. So those are fundamental analysis kind of traders. Okay, so let's talk about the sentimental analysis. Now, sentimental analysis simply means the use of data from players in the market. Okay, now for instance, when you're a sentimental trader, it's simply you're just trading out of sentiment. Okay, you just look at the behavior of the traders, how long they've sold, the length of the candles. I'll explain what candles means like shortly, right? So the length of the candles, the kind of players that are in the market, their sentiment. Do you think they are going to go long? Do you think they are going to go short? Are they buying? Are they selling? When you just trade out of those kind of sentiments, okay, it is called sentimental analysis. Okay, so now there's a specific elite group, I call them the elite group of traders, called the discretionary traders. These are traders that just use any information available to them to make trading decisions. So they can combine both the fundamentals and technical, combine sentimental. They just trade based on what is the best decision to make at this point. So these are called discretionary traders. Okay. Now there are different ways to enter a trade, which I don't think this is necessary to explain. Oh well, let me just explain that briefly. So there are different ways to enter a trade. Now there's instant execution. It's that simple. When you just click a trade, let's say you enter the trading platform, click buy, you are inside the trade immediately. You buy, you enter the trade immediately. If you sell, you're just instantly. Okay, that's why it's called instant execution. So in definition, this refers to the execution of trade position at the exact price offered by the broker at a specific time. Okay, now the difference with execution on request is that when you are executing a trade on request, it simply means you're telling the broker, put me in this trade when this particular price gets to this particular point, whether up or down, or take me out of this trade when the market gets to this specific point, or just an execution of trade that is not instant. Okay, is some part of this kind of request is called pending orders. Okay, then stop losses, take profits, those are all still execution on request. Okay, it simply means you're telling the broker to do this when price gets to do this. Okay, so that's just it, right? I don't want to make this much more complicated. Now, execution by market refers to where a broker makes a decision about the order execution price without any additional discussion with the trader, like things like stop out levels, things like margin calls and all of that. So this is execution by market, but let's just keep moving. Now, I already talked about brokers and what brokers do. Okay, so brokers are like your intermediary to the forex market. For you to trade, you need a broker. That's simple. You can't trade. You can't just put $1,000 in your domiciliary account and just start trading with it. You need a broker. Okay, you need to trade through brokers. Okay, so that's it. I've already explained all of this. Okay, in I think module 1 or 2. So module 4 is where we talk about the pips, lots, and charts. This is like the difficult part, but I'll make it really simple. Now, just like every other field of study have their own units of measurement. For instance, you want to measure my weight is measured in kilograms, right? You want to measure my height, you can measure my height in feet or in centimeter or in meters, right? You want to measure the length of the distance between two countries is measured in kilometers, right? Now, the units of measurement in trading, they have two major units of measurement in trading. Number 1 is the pip. Number 2 is the lot size. Okay. Now let me explain pips. Now, pips simply stands for price per interest point or percentage in profit. Anyone you call it is correct, right? This simply means the smallest whole unit of measurement of the difference between the ask and the bid price in the forex market quote. Let me explain that in layman's English. If I buy, let's say, if I buy this bottle of water here for 100 naira and I decide to put it out there for people to bid at 120 naira, that 20 naira gap is, we can call it a pip price, right? Now, I don't know whether I'm trying to even complicate this, trying to explain, but however you understand it now. Every single difference in the price of a particular currency pair is called a pip. Okay, now there are basically two types of currency pair quotes in forex, and their pip calculations can differ too. But before we go into that, the difference Now let me explain how to calculate the pip, like a very simple way for you to understand. Okay, now you've probably seen a price chart that looks like this, and this on a price chart, this represents the price. Now this represents the time on a price chart, right? So you've seen things like this, up and down, right? Now every of this is divided, all the price is divided into, let's say this is 0.1, 0.12, 0.13, 0.14, 0.15, 0.16, and all of that. By the time you look at this, for each one added value you add to this is called 1 pip. 1 pip. Okay, now let me explain that using like the real currency pair thing, right? So let's talk about this. Now there are basically two types of currency pair quotes in Forex, and their pip calculation differs. Okay, now in Forex you notice that there are actually two types of currency pair quotes that you get to see. We'll get to experience all of that like very soon. Okay, now there are those that have 4 decimal places, there are those that have 2 decimal places. Let me go back to the chart, and let me go back to my paint and explain that again. Okay, now currencies like the Euro USD, please forgive my writing, I'm actually doing this with like my hand, right? So Euro USD, the quote looks like this, let's say 1.0431. now this is an example of a currency that has four decimal places. Now the calculation of pip for this kind of currency pairs is different, okay, from those that have like 2 decimal places, which I'll explain shortly. Now if this moves from 1.043 to 1.0430, that means it has dropped 1 pip, because this last value here is what is called the pip. This is like the main calculation of the pip. It is calculated by from the last digit in the 4 decimal place. Okay, so if this moves again to 1.0429, this is another minus 1 pip. Okay, minus 1 pip again. So if you want to do minus 1 pip again, this is like 1.0428. we've subtracted another pip, right? Okay, so let me do the addition part so that it's not skewed. So we have Euro USD again, Euro USD. So let's say we have 1.0465. if I say add 2 pips to the value of Euro USD, what I simply mean is add 0.0002, which is 1.0467. okay, so this is plus 2 pips. Okay, plus 2 pips. So each movement of the 4th decimal place is called a pip. Okay, this is for currencies that have 4 decimal places. So if you're having a hard time understanding this at this point, you might just need to like get the Forex bootcamp, because this is much more explained in that course. But I'm hoping that you should be able to get this, right? So now for those that have 2 decimal places like the USD JPY, Euro JPY, NZD JPY, let me explain how to calculate theirs, right? Now currency like USD JPY have values like this, let's say 136.49, something like that. Okay, now if I say add 1 pip to this, I mean just add to this, which would give us 136.50. okay, when we add to this is like plus 1 pip. Okay, so if I say add let's say add 15 pips to this value, now to this particular value, what we have is 136.50 plus 0.15, which is 15. So what we have is actually 136.65. So with this, we've added 15 pips. Okay, so I mean, this should be really simple to understand at this point. I'm hoping that this is not confusing, especially if this is your first time actually, coming across the Forex market. I'm trying to make this simple, man. I'm trying to make this simple. Like I said, this is like a compressed 20 videos compressed in one video. So I'm hoping that you get this at this point, okay? But if you haven't, maybe you have hard time understanding things like this, mathematics like this, just grab the Forex Bootcamp course, man. I don't know how else to help you at this point. I think that's the only course that can just make this much more simple. I spent much more time explaining this at the Forex, the Forex Bootcamp course. Okay, so you might just need to get the course if you're having a hard time understanding this at this point. Okay, so but that's just the calculation. So let's just keep going. Now, calculation of pips for currencies with 4 decimal places. This is just like a summary. I already explained these are example of currencies that have 4 decimal places. As you can see, this is a Euro GBP, has 0.86800. Now, if you look at the quotes on the MetaTrader 4 platform, which we'll be explaining shortly, you see these things that looks like index. Okay, this is called a pipette. Totally ignore it. Just assume you're not seeing it. These things, these values that are that are on index form, as if it's a square root or square, whatever it is, just ignore this small, just act like you're not seeing it. Just work with these 4 decimal places. It should just make things easy for you to understand. Because if I start explaining what is pipette, all of that, just ignore it. Gaskia, ignore it. Okay, so these are examples of currencies that have 4 decimal places. Okay, so as you can see, 0.8680, 1, 2, 3, 4, 4 decimal places. 1, 2, 3, 4, 4 decimal places. 1, 2, 3, 4, 4 decimal places. So the 4th decimal place is actually highlighted, as you can see here. So these are all highlighted. So I said here is a picturesque screenshot of how pairs that have 4 decimal places are usually displayed. As you can see on the image, the 4 decimal places of the pairs have been highlighted with a rectangle, right? The 5th decimal place designated in index is called a pipette. Okay, so I already said just ignore the pipette. Okay, so for this kind of pair, the pip is calculated as the 4th decimal place. Okay, the change in the pip value is what determines the amount of profit for every trade position. I will explain that shortly. Okay, now this is an illustration. Now this is like the practical part. Now, from the image above, the value of Euro GBP is 0.8680. Let's go back to that. So this is Euro GBP. The value here is 0.8680, as you can see, right? So if, assuming we now say that Euro GBP has moved 5 pips upwards, the new price of Euro GBP would be 0.8685. Remember, our consideration is just the last decimal place, which is this 0 here. So we just add 5 pips. If we say market has moved 5 pips upwards, we simply add 5 to this number, which makes it 0.8685. It's that simple to understand, right? Now, this is another illustration. Now, let's take the value of Euro USD, which is 0.9974. Let's go back. This is Euro USD. This is the value, 0.9974. Okay. So if we say assuming we now say that this is Euro USD, sorry, this is Euro, not Euro GBP. Assuming we now say that Euro USD has moved 12 pips downwards, what do we do? Very simple. Subtract 12 from the last 4th decimal place. In this particular case, the last decimal place, because you can't subtract 12 from 4, you're subtracting it from 74 as a whole number, right? So when you do 0.9974 minus, remember 12 pips, if you want to call it like if you want to assume like a pip is the last 4th decimal place, right? We can say that 12 pips is 0.0012. That's 12 pips, right? So when we subtract 0.0012 from 0.9974, we would have 0.9962. This is like the simplest I can make this at this moment. Okay, now the calculation for pips, this is one for 2 decimal places, like I already explained. Now let's go. As you can see, these currencies have 2 decimal places, unlike the other ones. So mostly the currencies that have this are the JPY. Any currency that has JPY, most of all of them actually have these 2 decimal places. Okay, so the calculation for their pips is the last, that's the second decimal place. Ignore this other numbers. I already told you that. Okay, so act like you're not seeing them. So we're only working with 2 decimal places here, which is 5 and 7, 5 and 8 here, 1 and 8 here, 2 and 6. Okay, so these are the value for this particular pairs. Now here's a picturesque screenshot of hard pairs that have 2 decimal places that usually displayed. I already explained that. Now for this kind of pairs, the pip is calculated as the second decimal place. Let's just move to the illustration. It will make it much more easy to understand, as already explained in the first one. Now from the image above, the value of USD JPY is 147.57. Now this is, USD JPY 147.57. okay, now if we say that USD JPY has moved 15 pips upwards, that means the new price will now be 147.72. Now remember that 15 pips for this case can simply be illustrated as 0.15, 0.15, right? So if you add 0.15 to this 147.57, what we have is 147.72. That's simple, right? Now from the image above, we see that this is the second illustration. Now the value of NZD-JPY is 85.26. Now this is NZD-JPY. This is the value, 85.26. okay, now if we say that the NZD-JPY has moved 53 pips downwards, what does it mean? That means you are simply subtracting we're simply subtracting 0.53 from 85.26. So when you do that subtraction, what you have is 84.73. I don't know how else to make this much more simpler. So now this is the summary. This is like the summary. If you can't get it from this summary, I don't know how else to help you. Just grab the Forex course. So for currency pairs with 4 decimal places, we can say 1 pip is 0.0001. If we say 2 pips, 2 pips is 0.0002. If we say 17 pips, 17 pips simply 0.0017. If we say 230, if we say Euro USD has moved 234 pips up, what we mean is that it has moved 0.0234 pips. If we say the Euro USD has moved 3,500 pips, what we are simply saying, if you want to call it as a single unit, means that it has moved 0.3500 pips. Okay, this is for those that have 4 decimal places. Now for those that have 2 decimal places, the summary is 1 pip 0.01, 2 pips means 0.02. If you say it has moved 17 pips, means it has moved 0.17 pips. 204 pips means 2.34 pips, right? 3,500 pips, if represented, is 35.00 pips. Okay, so I think this is that's like the best summary. I don't know how else to summarize this to make it much more understandable for you. Okay, so that said, let's move to the next unit of measurement, which is the spread. Now the spread is just really simple to, my god, this is over 1 hour already. Okay, let's just explain the spread. In simple definition, spread is the difference between the ask and the bid price of a currency pair, otherwise called transaction cost. Now let me explain this like really simply. If I buy this bottled water, and if I buy for 100 naira and I want to sell it, and I decide to sell it for $20, and okay, I put it up for sale at $20, I have a supermarket, assuming that, right? So I bought this bottled water 100 naira and I displayed it for $150, on the price stand. Okay, What that simply means, the 50 naira that I added to this is simply my spread. Okay, so the difference between the bid price and the ask price is simply spread. So when you see a currency pair, displayed like this, let's say the currency pair value is 0.8680. Okay, when you just add the ask price is 0.862, the difference between this bid price here and the ask price is 2 pips. Is the value at which the broker is willing to buy a currency pair from you. Okay, that's the ask price. Ask price is the price at which the broker is willing to buy a currency quote from you. The bid price is the price at which the forex broker is willing to sell a currency quote from you. So once you execute a trade, they charge you the transaction cost. Okay, most times when you enter a trade, you enter losing already. You enter the trade already losing. Okay, because they have to charge you, for them to offer to you at that price. They have to charge you for that. Okay, so that's how brokers make their money basically. That's just the basic. They have other forms, in other ways they actually make money, but that's just like the basic way they make their money. They charge you spread. Okay, so the amount of spread for each currency pair keeps fluctuating in correlation to the volatility of that pair at any given time. Okay, but usually the higher the volatility, the lower the spread, and vice versa. Okay, so each pair, just keeps the price of each currency pair, just keeps the spread, keeps volatility. Oh god, the volatility of each pair and the spread keeps fluctuating, during the day. So it might just come today, meet like 10 pips spread, can come tomorrow, meet 2 pips spread, next room meet 3 pips spread. It just keeps floating, okay, depending on the condition of the market per time. Now I told you that there are 2 major measurements, types of units of measurement in forex. We already explained the first one. In fact, I'll just assume there are 3 at the moment. We'll explain the first one, which is the pip. We've explained the spread. Now I want to talk about the lot size. Okay, you need to know these units. Okay, now a lot is simply a unit for measuring a transaction amount in forex. It can be likened to any other unit of measurement such as kg, meters, pounds. I already explained that, but it is used for measurement specific to forex. Now there are 4 major classifications of lot sizes in forex. Okay, I'll explain that very simply, very simple way. Okay, now let's start from the nano lot side. The nano lot side is a lot size of 0.001. What that simply means is, let me move this so that it's not blocking anything. What that simply means is that for every pip, I already explained what pip is. Okay, just movement from 0.0002 to 0.003, that's 1 pip. Okay, now for every single pip, if I'm entering the market on a nano lot size, it simply means that for every 1 pip the market moves, I make $0.01. For a micro lot, simply means that for every 1 pip the market moves, I make $0.1. For a mini lot size, means that if I enter the market with, let's say, 0.1, for every pip the market moves, once the market moves 1 pip, I make $1. If it makes another pip, $2, pip, $3, pip, $4. That's if I'm entering the market with a 0.1 lot size. Now, if I'm entering with a lot size of 1.0, simply means for every pip, $10, pip, $20, pip, $30, pip, $40. Right? It's just the simple explanation of this. Now, okay, I thought there was much more detailed explanation on this, but however, let me go to my paint and try and illustrate this for you. Okay, so let's assume I have a 1,000 let's assume I have a $1,000 account. Okay, and the price of Euro USD, let's just signify as EU, is 0.3925. okay, this is just an assumption, 0.3925. This, my 5 is looking weird. It's looking like 5 now, right? So I have 0.3925. This is the current price. Okay, and I want to enter the market with, let us assume I'm entering this market with 0.1 lot size. 0.1. This is my lot size. Okay, and from what we saw here, 0.1 lot size means $1 per pip, right? Sorry, means $1 per pip, right? Now, if this market moves, and let's say I'm a buyer in this market, and this market now moves for, let's say, 30 pips upwards, that means this price now became 0.39 plus 30. What do we have? 55. Okay, so this is a new price, which is 30 pips, right? So if this market moves 30 pips upwards, and I enter this market with 0.1 lot size, remember I enter with 0.1, that means for each pip the market move, I was making $1, $1. So if I decide to exit the market at this price, I have made $30. It's that simple, right? But if the market moved, let's say I went for a buy, but the market went down, okay, and went down 30 pips, what does that mean? I've lost $30, right? So you can now see that in Forex, if you want to make more money, you would be willing to risk more money. Now, let's assume again, this is the second illustration now, and we'll be done with this lot size thing already. Okay, let's assume I have a $1,000, right? And the price of EU, the current price of Euro USD is, let's say, 0.9532. Okay, now, but this time I decide to go with the lot size of 1.5. This is my lot size. Now remember, before we continue with this, just be assured, be aware that it must not be 1.0. This can be 2.0, this can be 3.0, this can be 5.0, this can be 100.0. Now this can be 0.2, 0.3, 0.4, 0.5. So just because you're seeing 1.0, this is just for illustration. It can be anything. This can be 0.03, 0.05, 0.02. It's just the decimal point that is just the position of the decimal point that is like the major thing. So this can be 0.005, 0.003, 0.00. Just, it can be anything, right? So just for you to know that, so that you're not, you're not stereotyped. Okay, so let's assume I went into this market with 1.5. Okay, now remember that this is our lot size. This is lot size. Let me designate it as lot in case you want to take a screenshot so you don't forget this. Now, a lot size of 1.5, and the market moved, let's say, 50 pips upwards. Remember, we went for a buy. On this, buy on Euro USD. If the market moves 50 pips of this, what's the new price? The new price would be 0.9582, right? This is 9532. When you add 80 pips, which is adding 0.00, sorry, when you add 50 pips, which is adding 0.0050, as already explained to you, what we have is 0.9582, right? So when you have this now, when the market moved 50 pips and we went on buy with our lot size of 1.5, it simply means that, remember, 1.0 lot size signifies $10 for every pip move. Okay, so for every pip move we're making $10. So in the case of the trade where we enter with 1.5, it means that we're making $15 per pip. $15 per pip. So for every movement, every pip, $15, pip, $15, pip, $15, because our lot size is 1.5, right? So if we do that, what do we have here? We've already made, in this trade, we've made 15. That's let me do the calculation quickly. That's 50 multiplied by 15. Sorry, 50 multiplied by 15. We have made $37,500, okay, just by a 50 pip move. Okay, I hope I did the calculation correctly. 15 times 50, 750. I was wondering, sorry, that's $750. So in this case, we've made where do I write this now? We've made an additional $750, okay, because we moved 50 pips each of those pip was what? $15. So 15 multiplied by 50 is 750. Oh my god, where did I get that $37,500 value? I think that was a mistake in the input value I had on my calculator right here. Okay, so but that said, you already know how to, I assume you already know how to do this calculation. It's that simple. Okay, so let's keep going. So that's it for lot size. So already you see how the lot size relates with the pip. So that's why they are the two major units of measurement in Forex: lot size and pip. Okay, you need to understand lot size and pip and the value of dollar in relation to the lot size you're using per pip. Okay, so that said, let's just keep going. Now let me introduce you to chart representation. Charts are simply a graphical representation of the fluctuation of prices over a given period of time. Okay, now traders use information shown on the charts to make their trading decision. Okay, now a good trader is someone who can make the best trading decision using this kind of information. Now this is an example of the chart. Okay, let me explain everything you're seeing here. Now this is a chart of the New Zealand dollar and the Swiss franc, right? Swiss franc, whatever the pronunciation is, man. So this is the price, these are the prices. Now this is the time. Okay, so this is a representation of everything that happened on this chart within this particular time. Okay, so this is what a chart looks like. Okay, now this is a sample of NZD CHF 1 hour chart. Okay, so I'll explain time frames and all of that like shortly. Okay, so as you can see, the time is plotted on the X axis of the chart, while fluctuations in price are plotted on the Y axis. Okay, now of course with your knowledge of basic physics, this is the Y axis and this is the X axis. Okay, so the chart is a clear representation of how the price of a particular currency pair kept fluctuating within this period of time. Okay, in this case, this is like, I think, a full day, because each of this candle is like 1 hour. Okay, so this is an explanation of what happened within no, this is not, this is like 4 days, I think so. It's like 4 days, right? So this is an explanation of what happened within 4 days. Okay, now let's talk about the market highs and low. The market high is simply the highest price the particular currency is traded at a given time, while the market low is simply the lowest price the particular currency is traded at a given time. So in the case of this kind of chart, a market high is like the highest the price ever got to within this particular time, and the low is, this is the lowest price it ever got to within this particular time, right? So that's just it for market high and lows. Now there are different ways to represent candlestick charts. Okay, we have the line chart. Now as you can see, this is just a line where you just plot time against price, just draw a straight line. This is what you have. Now this is the bar chart, where is it presented in different just in bars. Okay, it shows you the high, the low, the open, the close, but I won't go into this. Now our interest is the candlestick. Okay, which if you want to learn how all these things were derived, because knowing how this line chart, bar chart, and finally the candlestick was derived will give you like a better, much more advanced knowledge about how to read and interpret, do analysis on charts. Okay, so those things are explained in the full course. This is like over 1 hour already, which I didn't plan for. Okay, so let's just keep moving. Okay, let's just keep moving. So let's move to module 5, where we talk about the patterns, analysis, support and resistance, and I'll explain that shortly. So here's a full approach to the candlestick. Trust me, to be sincere with you, this is not full approach because the full approach is on the full course, but I'll give you just enough to get you started. Okay, so now here is what we call a Japanese candlestick. Okay, a Japanese candlestick gives you 4 major informations. It gives you an open, that's the price at which a particular price opened. Okay, the open price. Let's say each candlestick can represent a full day. Each candlestick can represent 5 minutes, it can represent 1 hour, it can represent 4 hours. Okay, For instance, let's assume that this is a 4-hour candle. That means with just this single red bar we're seeing here, let's assume this is a representation of what happened in the market within 4 hours. Within 4 hours, this is what happened. So it tells us four information. It gives us the open. This is open. Open means this is the price it opened. This is the first initial price when the 4-hour candle opened. High means this is the highest point it ever got to. Okay. Low means this is the lowest price this particular the price of this currency pair actually got to within 4 hours. Okay. The close means, which is here, actually not here, this is the closing price. It shows you the close, that's the price at which the exact price, the price of the currency pair was as at the time the 4-hour time frame was fully formed, and at the expiration of 4 hours. Okay, I think this is simple to understand. Now this is the same thing for whether a bearish candle or a bullish candle. Okay, so for a bullish candle is a candle that has its close at a higher price than the open price. A bearish candle is a candle that has its close at a higher price than the open price. Okay, so as you can see, for a red candle, it simply means that you opened here, closed here. Okay, open higher, closed lower. For a bullish candle, it opened this is the open price. Don't know why it's not indicated here, but this is the open. You opened here and closed higher. Okay, so that's it for candlestick. I think this is basic understanding that you need to have to get you started. So introduction to chart patterns, I definitely would not need to go into this. I don't need to get into this like fully. You don't need this to start trading with us, okay? Because I just want to give you enough to get you started, to get you to the point where you take your first trade and get you learning from there going forward. Okay, now candlestick sentiment and analysis, I think I already explained this, but reading this up can give you like an overview of what that means. But however, basically a single candlestick tells you what the players, that's the buyers and the sellers, are currently doing in the market. Candlesticks give you an insight into who is in control of the market at any given time, whether it's the buyers or the sellers. In this instance, as you can see here, when you see this candle, when it is green, now candlestick are designated, have different colors. For some people, they might like blue and red. Some people like green and red. It's all, but however, generally a red candle means a bearish candle. That means down. Okay, it means that the price was up, then it went down, bearish. Okay, when you see a blue candle or a green candle, as the case may be, some people can use black and white. I don't know, those guys are really weird, but the general thing is red and green or red and blue. So when you see a green candle, it means that open price was lower, the price went higher, then closed. Blue candle or green candle. Okay, so that's it, just the colors that indicates that for you. So there are different types of candlestick patterns. This is not the video to go into this, okay, but I'll just show you these three. Let me just be patient to just go through these three for you, because I want you to learn Forex, okay? In as well, I'm trying to just rush this, because at this moment of this video, like, I'm really tired. My mouth hurts, but then I need to do this so that you learn this. Okay, so hammer. So there's a kind of hammer candlestick pattern. There's a kind of candlestick called a hammer. It looks just like this. Now explaining this, as you can see, the color is green. What it simply means is that from what I told you about the open, the highs, the close, it simply means, I think I need to use a paint to explain this so that it hits home. Okay, so this is what a hammer looks like. Let me color this. Let me put green. Oh my god, oh my god, is this not closed? Oh my god, sorry about this. Paint is usually just really frustrating most of the time, but I'll try my best anyway. Okay, good. So this is what a hammer looks like. Okay, now it simply tells you that when this, remember I told you about the open, there are four things to deduce from a candlestick. Okay, the open. For this to be a green candle means that definitely the open was lower at this point. Sorry about that. So this was the open. This place is the open price. Okay, so the price opened here, but at some point, this is the low. This is the low. At some point, that means that this price pushed all the way down here. That means the sellers or the bears pushed the market all the way down, pushed it to this point. But however, the buyers were able to still push it up to this point and even push it past and above the open price, and finally closed out here. This is the closing price. Forgive this my writing, I know it's rubbish. So now let's assume that this like had a candle on top. This would be like the high. So it gives us 4 information. So what that tells you is that at this point is like the buyers are stronger than the sellers, right? Because the sellers pushed this thing all the way down, but the buyers had a way pushed it up, pushed it even past the open price, closed it at a higher price. Okay, so that tells you that, you know, buyers are in control. So that's like the basic about candlestick sentiment. So when you see candlestick patterns, it just shows you different kind of information. So for this, it's clearly saying that the buyers are in control. Now a doji shows you that there's a struggle. It went up, went down, but still closed. The the open price and the close price still the same price. That tells you that more like it's a struggle happening here. The buyers are trying, the sellers are trying, but they are still at equilibrium. Okay, now there's a bullish engulfing pattern, which means that, you know, the sellers were, you know, trying to push the market down, then all of a sudden, you know, the sellers, the buyers, sorry, pushed it all the way up. Okay, that's why it's called engulfing. The body of this buying candle is higher and is engulfing of this, you know, red candle. Okay, that's the bullish engulfing. But these are long. This, if you want more information about this, grab the course, man. Grab the course. I can't explain all this, but this is just the summary of, you know, all of this. You can go through the manual, go through this video, and you can understand this for yourself, you know, using the explanation I already gave you. Okay, so now these are types of chart patterns. Okay, simple definition: chart patterns is a shape within a price chart that suggests what prices might do next based on what they have done in the past. So chart patterns are things like this. When you see something like this, like this, like this, like this, there are different types of chart patterns out there. Okay, so like I said, when you're a technical trader, what you're looking to do is to study the behavior of price over the years or over the months and predict that if you see that kind of pattern again, the price might actually do the same thing it has done in the past. Okay, so this is like this is like, you know, different chart patterns that people use out there to make their trading decisions. Okay, so I got this image from newtraderu.com. so now let's go to time frame analysis and their relevance. Okay, now time frame refers to a summarized outlook of the behavior of the price of a currency within a specific period of time, usually represented by candlestick. Okay, that's simple. Now there are many different time frame representations offered by different trading platforms. Okay, but the most popular are M1, M5, that's minutes. M1 means 50, M1 means 1 minute, M5 5 minutes, M15 15 minutes, M30 30 minutes, H1 1 hour, 4 hours, H4 4 hours, weekly, daily, monthly time frame. Okay, so mathematically, let me explain this using this image here. Now this is like an image of what happened in the market, you know, for a single day. Okay, everything you're seeing here happened in the market for a single day. Now each of this candle is a daily candle. Okay, or each of this candle is a daily candle. Okay, that's for this red candle 1 day, this green candle 1 day, green 1 day, red 1 day, this doji candle 1 day. You understand what I'm trying to say, right? So but if you zoom into 1 hour, this is what it looks like. Everything you're seeing here is a representation of everything you are seeing here. Okay, so this full red and green candle can be represented by this. Okay, can be represented by this. Okay, so when you zoom in every single time frame to a lower time frame, it shows you much more information than what you saw on the higher time frame. So that's just basically what time frames are. I already explained in the previous module that a single candle can be 4 hours, it can be 1 hour, it can be daily. So it's candlesticks, you can just call them summaries. A single candle is a summary of what happened within 1 hour, or in 1 day, or in 1 week, or in 1 month. Okay, so that's it. So no need to go through this. Okay, so let's talk about support and resistance. Now this is for technical traders. If you're going to be a technical trader like myself, I'm a technical trader. I like trading technically, right? So there is a theory called the support and resistance theory, which simply means that price tends to react a certain way when it gets to a certain point. Let me just explain that using paint. Okay, let me explain that using paint. I don't know why this is not okay. Good. So the theory of support and resistance is a theory that that illustrates like a house setting. Okay, in a house you have the roof and you have the floor, right? So this is like a house, right? So this is the roof, this is the ground. What the theory suggests is that when the market gets to the roof, there's a form of resistance that tends to push it down, and when it gets to the ground floor, there's a form of resistance that tends to push it up. Okay, that explains why the market keeps moving in this kind, keeps doing this kind of movement, right? That's just the theory. Okay, that's just the theory. Now it's with the knowledge of this theory that we tend to take trades in forex. Okay, so this is basically what the theory says. It says that it's a resistance is a point where there are a cluster of sellers looking to push price down, and the support is a price where there are buyers looking to push price up. Theory also says that when a resistance zone is broken, as you can see here, this place was resisted here, resisted here, resisted here, but it was now broken at this point. The theory says that this resistance can now become a support. So when a resistance is broken and price comes back against that resistance, the resistance tends to become a support to push price up. Okay, so that's why you typically see something like this on the charts. Okay, something like this, something like this. So let's assume this is the first resistance zone, support, sorry, these are all resistance and support zones. So for a market to let's say it's trending up, this resisted here, resisted again, then got broken here, then this former resistance now becomes a support here. Okay, that's what the theory says. Then goes up, then this is now the new resistance. Okay, goes up. Now if for any reason this resistance is broken, this resistance now becomes a support. Okay, so this is like what the theory says. So if you're a technical trader, this is something you might need to add to your knowledge of trading and improve your trading results. Okay, but I won't be going into that. If you want more details about the trading, the support and resistance theory, of course you know what to do, right? So it's a theory that suggests support and resistance theory is a theory that suggests possible areas of chart or price where there would be either a surplus of buyers or surplus of sellers. Okay, a support is simply a historical area of the chart where there was surplus of buyers with possible proof of upward movement of price when the price got to that level. Okay, now resistance is simply a historical area of the chart where there was a surplus of sellers with proof of visible downward movement of price when the price got to that level. That's just a summary of that's just like a summary of everything I explained here. Okay, as you can see, the price moved down when it got here, moved down when it got here. You understand? So once you've seen this, it moved down here, there's a possibility that once it gets here again, it can come down again. So if you're a seller, you can decide to sell here. If you sell here, this place would have been a profit for you. Okay, so that's just the history of how it works, right? So let's just keep going. So summary, this is just a summary picture of the support and resistance thing. Okay, so I think okay, I think it's good to mention it. Ideally, support and resistance zones are not lines on the chart, but zones. Okay, so it's not actually a particular price, it's just a zone, like within a range of prices. Market reacted like that in the past, so you're hoping that the market reacts like that going forward. Okay, so basically that's just it. So let's just keep going. Okay, I think this is the end of module 1 to 5. So we'll move to module 6 to 10, where we talk about some other things in detail. So catch you like right away. So welcome back. So this is module 2. This is the second part of this handbook. This is module 6 to 10, where I'll be telling you much more in-depth stuff that you need to know about the forex market. Once again, this was not supposed to be like a free handbook anyway, but I'm giving it out for free in this particular video. So let's just keep going. So that's it. Let's talk about terminals, market orders, and trade execution. Now, I already told you that you need a broker for you to start trading. Okay, you need to be signed up with a broker. Now, another thing you actually need to start trading off is a trading terminal. Now, there are different trading terminals out there, but these two right here are the most popular trading terminals: the MetaTrader 4 trading terminal and the Trading View. Okay, now a trading terminal is a software used to access real-time financial information, make analysis using indicators, place and to also place orders in the forex market, either you're buying or you're selling. Okay, now it's very simple. Let me just explain that like in a very simple way. Let's assume now you want to start trading. Okay, you've set up an account with a broker and you now want to start executing trades. Okay, you need to log into a platform like the MetaTrader 4. For the sake of this training, I'll just be using, for sake of this training, I'll be talking about the MetaTrader 4 only. Okay, you need to log into the MetaTrader 4 to start executing trades. Okay, because it is through that trading terminal, which is the MetaTrader 4, that you can send commands to the broker to execute an action in your trading account. That is where you buy, that is where you sell. Okay, so both of these terminal, both the MetaTrader 4 Trading View, have mobile and desktop versions. Okay, so let's talk about how to navigate the MetaTrader 4 software. Okay, it's really a very simple software to actually navigate. Okay, and I will explain how to do that. Probably I'll just do a short video just to explain that separately, how to navigate the MetaTrader 4 software. Now, most of the traders I know and myself, I execute trades on the MetaTrader 4, but I do my analysis on Trading View, on the desktop version of the Trading View, because it gives me much more sophisticated outlook on the market. Now, I have a video on this channel where I explain every single thing you need to know about Trading View. So search on this channel, you will see my video on Trading View. So you don't need to like watch any other video after watching the video I did on Trading View. It is really explicit and full. Every single thing you need to know about Trading View, I explained it on that video. Okay, and how I do my analysis on Trading View. So go and watch that video after you're watching this, you're done watching this one, to learn how to do use Trading View. Okay, so that said, now there are different pages on the MetaTrader 4 smartphone platform, which I'll probably just do a separate video just to explain all of this. Okay, so I'll just do a video down how to use the MetaTrader 4. So then you might just need to watch that video separately. Maybe I'll just tag it somewhere as you're watching this video. Okay, so let's talk about types of market orders. Now, there are basically 5 different types of market orders available on the MetaTrader 4 platform. Okay, the market execution. Now, this is an order where you tell the broker to instantly put you in the market at an exact price of a particular currency, either a buy or a sell. Okay, now there are other types of market market orders which are called pending orders. Okay, this is the buy limit, the sell limit, the buy stop, and the sell stop. It's simple. I think let me just use my pens to explain this better. Okay, the buy stop, let's start from the buy limit. Okay, buy limit simply means, let's assume this is the market and this is the current price. Okay, this is the current price. This is where the current price of the currency pair actually is at this moment. Okay, so but however, you want to enter this trade, but this is where you actually want to enter. This is where you want to enter. This is where you want to buy. Okay, but at the moment, this is where the price is. Okay, so buy limit means you're telling the broker, if for any reason this market gets to this point, put me in the trade. That's a buy limit. Okay, a sell limit is the opposite of that. Okay, the sell limit is actually the opposite of that. A sell limit simply means, if this is the price, and let's assume there's the current price of things. Now, this is where the market currently is, but this is where you want to enter. This is where you want to sell. Okay, so you're telling the broker, if this market price gets here, put me in on the sell. That's it for sell limit. Okay, so the buy stop and sell stop is actually just opposite of the buy limit and sell limit. So for this instance, for a buy stop, let's assume once again this is the price and market is going all the way up, but this is where you actually want to buy. This is where market is. So you're telling the broker, if market gets to this price, put me in on a buy here. Okay, that's simple, right? Now for the sell stop is actually simple too to understand, nothing complicated over here. Simply means the price is going all the way. This is the current price, this is the current price, but however, this is where you want to enter for a sell. So if this market pushes all the way down here, the broker puts you in on a sell. Okay, so these are all the four of them I just explained are all pending orders. Really simple to understand, right? So let's keep going. So this is, I just explained everything I just explained to you is the buy limit, sell limit, the buy stop, and the sell stop. Okay, now how to place a trading position, probably I will handle this on the video tutorial on how to use MetaTrader 4. Okay, I now said placing a trading position on a MetaTrader 4 is as easy as clicking a button on your phone. Every trade executed on the MetaTrader 4 platform has 4 adjustable parameters: the entry price, the lot size, the take profit, the stop loss. Now, when you enter a trade, the price at which you enter the trade is called the entry price. You can't change it. You can't change your entry price once you have entered the trade. And also your lot size, the lot size you use to enter the trade. We already discussed lot size in the previous modules. You can't change your lot size. Okay, if you entered with, let's say, 0.5, you can't change it. Okay, but however, you can modify. You can close, if your trade is in profit or in loss, you can decide to close out 0.25 of your trades in profit or in loss, but you can't increase the lot size that you used to, initial lot size that you used to enter the trade. You can only reduce it by closing out some of your trades, some part of your trade in loss or in profit. Okay, so there's a take profit price and the stop loss price. You can actually adjust these ones even if you're in the trade. Okay, so if you see that the trade has more potential to move further, let's say you're a buyer in the market, you can adjust your take profit, make it a little bit higher or lower as the case may be. Okay, so let's talk about broker spread. Okay, I already explained what a spread is, haven't I? Have I can't remember, but however, the spread is just the difference between the ask and the bid price. I think I've explained this. Now some brokers offer a particular kind of commission called offer a kind of account called an ECN account. Okay, it's an account, instead of charging you for the spread, they charge you commission for each trade that you're entering. So for every trade that you enter, they charge you a particular amount for that trade. Okay, depending on the lot size. Now there's a swap fee. Swap fee is an amount they charge on your account when you leave the trades overnight. Okay, so that's it for that. So risk to reward simply means if, for instance, you enter a trade with $100. Sorry, let me take water. So risk to reward ratio simply means how much you are risking and how much that you're hoping to make. If I say my risk to reward ratio is 1:3, that means I'm risking 1 to make 3. If I'm risking $100, I'm hoping to make $300. If my risk to reward ratio is 1:4, that means if I'm risking $100, I'm hoping to make $400, right? So that's just the basic thing about risk to reward. Okay, so I explained how these things work like much more detail in the full course, but we'll be moving ahead with that. So trading psychology. Now, one thing you just need to understand, I think you just need to go through this handbook. If you've not downloaded it, please download this at this point so you can just go through this with me as we're doing this together. Okay, now risk management simply refers to a set of rules that allows the trader to manage their risk when you're involved in forex trading. Okay, now you need to know this: forex market is risky. That's just the fact. You can't get away from that, because in this market you are risking something to make something. You cannot be risking zero. Okay, you must be, if for you to trade, let's say you want to trade with $10, you must be risking $10 to make, let's say, 20, 30, or even risking $10 to make $1,000. It's possible. You understand? Now, if you have a trading capital of $1,000, when you want to enter a trade, it doesn't mean that you're entering with all the money in your trading capital. Okay, you can have a $1,000 account, but for each trade you're risking $5. That means you're risking $5 to make 20, $5 to make 300, $5 to make 50, whatever amount that you're hoping to make out of the trade, depending on your risk to reward ratio. So a good risk management simply means that you have a strategy that tells you when to leave a trade, a strategy that tells you when to close out a trade, whether in profit or in loss. So that's just the crux of risk management. Okay, is a set of rules and decisions that allows a trader to effectively manage their trading risk in forex trading. Okay, so now full approach to trading psychology. Now this is something that a lot of traders miss out. I won't go into full details in this particular tutorial, but however I went like in depth, because as this is what separates the boys from the men in trading. Okay, your trading psychology. If your trading psychology is bad, you make like really bad trades. Now these are like the 4 major kind of emotions people have in forex trading. Number one is greed, because number one is hope. Sorry, let's start with hope. So most times when people come into forex and they see the amount of huge money you can make huge money in such a short time. I've seen my highest like one time trade, like 1 week, was over like I think $20,000, like in a space of 1 week or so. It was really amazing, a whole lot of money. So by the time people come into forex, they see that it's possible to make that amount of money in such a short time. All their mindset about trading is, they just throw away all caution. They just begin to just believe that if this can happen for this other person, it can happen for me. They just begin to hope. Okay, and hope can really mess you up here, because hope is not a strategy in trading. Number second emotion I can feel is greed. So people, they open a trade and the trade is on $1,000 profit, but because they are greedy, they want more. They want for trade to make $3,000. They don't close it out, they leave it open. Before you know it, they lose all the $1,000 and even lose part of their capital. That's greed. Some fear. Some are afraid to enter a trade because maybe they've entered the first trade, it ended in loss, entered the second one that ended in loss. They are now scared. They don't even want to enter another trade again. That's another, it can mess you up a whole lot. Okay, now there's fear of missing out, which is FOMO. A lot of people, because of these guys, they're entering it, all of them, they have like maybe a clique of friends, all of them are going by, and because they don't want to miss out on what other guys are enjoying, they just jump into the trade without analysis, without anything. It can mess you up. So trading is an emotional game, man. You can't take that away. Trading is an emotional game. Okay, you need to learn how to manage your emotion and your trading psychology. Okay, I think this is just a recap of everything I've already explained to you. So strategy development is where you begin to maybe go through the charts, do your technical analysis, back test, trying to check everything the markets have been doing over a while, trying to develop your own strategy. Okay, that's what it means to have a strategy, to do strategy development. Okay, like I said, I will not really be going in depth into my strategy. It is actually exclusive to the guys on our Forex Bootcamp program, in our Trade Academy program. But however, I think with what with the things I've taught you so far, this is enough to at least get you started, using our signals to trade free of charge. We ain't charging you nothing, man. We ain't charging you nothing to trade with our free signals. Okay, so during your strategy development, that's where you start finding out your trading your entry conditions, your management conditions, how to exit your trade, what are the conditions that you need to see for you to exit a trade. Okay, it's really a very simple stuff. Now indicators, I won't go into indicators, it's much more complicated thing. Okay, so now, but however, indicators in Forex are mathematical tools that helps you to analyze specific information in the market and or suggest a trading decision. So indicators are simple. Indicators indicate. Very simple. That's just a simple explanation. Those are mathematical tools that people like you and I put up indicators to help better their trading decisions, to help them make better trading decisions. So I can decide, okay, come up with a tool that tells me that, okay, the market has moved 20 pips, and I create an indicator and it becomes my own personal indicator that, of course, any other person can use it out there. So anytime the market moves 20 pips, my indicator tells me that the market has moved 20 pips, go ahead and buy, something like that. So these are just indicators. Okay, so as you progress in your trading career, it is very probable that you find one or two more indicators that will highly suit your trading style. Okay, so now let's cash out. Now this is where I actually talk about my strategy, but I will not be talking about that. I have three strategies, like I said in the beginning, that we use to trade the Forex market. I have the jackpot strategy, the maximum strategy, and the martingale strategy. A lot of people, when I say I trade martingale, a lot of people they're just scared. But the way I trade martingale, trust me, a lot of people know nothing about martingale. Okay, but however, this part of this tutorial is exclusive to my students. Okay, so this strategy is where I teach them where exactly to buy, what I need to see in the market for them to buy, how to sell. The strategies have made me millions of money in this market. This is the same strategy I told you that I used to make $20,000 within just a space of few days. Okay, that same strategy is the same strategy I teach in this particular course. So I mean, you need to get the course if you actually want to learn the strategy. But however, you just want to use our signals, I mean, totally fine at this point. Okay, so I just want this video to be less than 2 hours. That's why I'm actually rushing this. Okay, so developing a trader's edge. Now, an edge in the market is simply a technique, approach, trading method that a trader believes can give them an advantage over the market on the long run. Now, success in trading all boils down to probabilities. Okay, in the Forex market, nothing is sure. There is no strategy that is 100%. There is no strategy that makes you money all the time. That kind of strategy does not exist. Okay, but what you need is an edge. An edge simply means a set of a technique or an approach that you use to trade the market that and you are sure, you have tested, you've trusted, that if, for instance, you take 10 trades, 7 out of the 10 would be winning trades. Because in trading, you have wins, you have losses. But at the end of the day, what you're hoping is that your wins are more than your losses. So that strategy that makes you assured that your wins would be higher than your losses over a particular number of trades is your trading edge. Okay, for me, my trading edge are my strategies I use for trading. I know my strategy, especially the marksman and the jackpot strategy has like 65% win rate. The marksman strategy has between 65-70% win rate. That means 70% of the time I know if I see this and do this, it gives me the result. Okay, that's just basically what a trading edge simply means, right? So there are two major ways that traders develop an edge in the markets: by experience or by backtesting. So if you spend a lot of time in this market watching the market move up and down, there come a point in time where you just can predict what the market will do. If you just look at the market, you can predict to a certain degree of certainty that the market will do this kind of thing next. So that's it for experience. Now backtesting means when you have a strategy, go back historical data, test it whether your strategy works, works in the past, and whether it's possible that it will work for you going forward. Okay, so now this is a review on trading psychology. Okay, now let's just do this. Okay, now there are different a trader must bring his mind and body to the point where his decisions are totally uninfluenced by his emotions and feelings. When this happens, the trader is said to be in the zone. Trading in the zone is something we advise for all our students. Now if you're trading, you need to put your mind in a position where it is uninfluenced by emotions. It is uninfluenced by what you're feeling, the fear, the greed, the FOMO, the hope, everything. You just need to trade based on your analysis and your strategy. That is what it means to be in the zone. Okay, so it's good to avoid trading when you're in a bad emotional state. Okay, so that's just basic things that you need to know. Now getting set to start trading. Now, there are a lot of factors that you must consider keenly. These are things I explain like fully in the course. Okay, now as a good trader, you need to allot like time for you to actually trade. Allot time for your trading. Don't just go trade anytime you want. Allot specific time for your trading. Now target, you must have a target for your trading. Set realistic and achievable goals in your trading journey. Withdrawal plan, have a withdrawal plan. Okay, I explain why these things are much more important in the full course. Okay, now these are the demands of a professional trading. Now trading is a profession. That's why a good trader is called a professional trader. Okay, is not a gambling, is a skill, just like every other skill. Maybe you went to school. I'm a physical therapist by training. I did physical therapy. I'm a physiotherapist. I did 5 years in school. I started learning Forex from when I was on campus. I have a full video on this channel dedicated to my story in trading. Okay, how I started trading while on campus. But however, it took them 5 years to certify that this guy, if you give this guy a stroke pressure, he can handle this pressure, perfectly, right? So it takes that it takes a practice in the market for you to come to a point where you become a professional. So it might not happen overnight, but over a little while, with coaching, which is what we offer at the Trading Academy, you can really become excellent at trading. Okay, so it's not gambling, it's not a get rich quick scheme. Just like every other business, it requires capital, it requires intelligence, it requires time for you to grow and to scale. Okay, nice. I wrote here, practice is what makes the difference. Nobody becomes great in trading just by knowing only the theory. You need constant practice to become good at trading. Okay, so that said, startup capital, we recommend minimum $300. It's good, we advise don't start with anything less than $300. You might lose the money. You can start with less than of course you can start trading with $50. You can start with $10. I started trading with $5, man. I started trading with $5, but I lost the $5. And the reason why it's good to start with at least $300, so that your risk management is a little bit tight, so that when you're risking 2% per trade, the profit is actually a little bit sensible to you. Okay, if you risk $5 per trade and you make $10, it's much more sensible. Okay, but if you're risking $100, I don't know. But however, people just have different approach to their account. But a lot of people might not think the way I think in trading, but very risk averse in terms of trading. So I I don't just advise, because I see a lot of people just come trade with $100. They are risking $50 per trade. That means if you lose 2 trades, you've lost your entire money. It doesn't make any sense to me. Okay, but however, start with whatever capital that suits you. Okay, but for our signals, we advise at least $200, $300 for you to start following our free signals. Okay, now full recap. I think I wouldn't move to the part how to get investors and all. I'll leave that part for exclusive. Okay, so now here's a full recap of everything we've discussed. So in this course, I've already explained to you, Forex is not a get rich quick scheme. Forex is a game of risk. It is mentally demanding. Develop a long-term mindset. Losses are also part of trading. Okay, so I think I'll stop that here. Now, if you are just part of this video, what I advise you to do now is watch the next video on how to use the MetaTrader 4 platform. I will do that video like I've not done the video at this point of creating this video, but I'll do that video to show you how to place trades on MetaTrader 4, how to connect your accounts to the MetaTrader 4 platform, and how to make money using our trading signals if you want to start following our trading signals. Okay, so that said, I mean, thank you for being a part of this course. It's been awesome having you here. So thank you. Let me make this bigger. Good. So thanks a lot for being a part of this amazing course. I hope I've been able to guide you on every single thing you need to know about the Forex market and how to get started. So watch the next video on how to use the MetaTrader 4 platform and how to follow our trading signals for free money in the market. Okay, so that's it. Cheers. Catch you some other time. Bye.